This chart shows a textbook technical buy setup. We have a clear bullish structure, a bounce off strong support, and a buy signal. But watch what happens. The price plummets, takes out your stop loss, and then immediately shoots up in your exact predicted direction. That sudden drop is entirely intentional. Institutional algorithms hunt these dense clusters of retail stop losses, resting strictly below support. In market mechanics, this pool of resting orders is called liquidity, and it acts as the necessary fuel to drive the actual move. Once the price hits that liquidity zone, one of two distinct events occurs. The price either triggers the stops and violently reverses upward, a liquidity sweep, or it plows through the orders and accelerates downward, a liquidity run. Relying on generic support lines leaves you guessing which outcome will happen. To survive, you have to read the structure and predict whether the market will sweep or run before the trap is ever sprung. Look at this basic sideways market channel. The massive pools of stop losses sitting strictly above the resistance line and below the support line make up the external range liquidity. Meanwhile, the scattered clusters of orders trapped entirely inside the channel form the internal range liquidity. Live markets rarely stay boxed in clean rectangles. Active trends move in complex zigzags, obscuring liquidity pools. External range liquidity sits exclusively at major structural swings. Internal range liquidity builds at minor pullbacks trapped entirely within those bounds. Treating a minor internal pullback like a major structural swing leads to a fatal miscalculation. It causes you to place orders precisely where the market intends to hunt for fuel. This gives us our first predictive rule. When a bullish market dips to target internal range liquidity but stays securely above the main major swing low, expect a liquidity sweep. The price grabs those internal stops and immediately reverses back to the upside. Conversely, if the price targets external range liquidity by breaking completely through that main structural swing low, the primary structure is broken. Expect a liquidity run, where downward momentum continues uninterrupted. Let's test a bearish structure. The price pulls back toward a highlighted zone. Evaluate the surrounding major swings. Is this internal or external liquidity? Because it sits strictly between the major high and low, it's internal. Price sweeps the stops, then aggressively reverses downward. Applying these two rules forces you to stop reacting to individual candles and start anticipating the geometric logic of the market structure. Let's track a live formation. This major swing low locks in external range liquidity. A minor pullback creates internal range liquidity. Price retraces into this minor low, sweeping stops while staying above the major low, then instantly accelerates upward. The methodology distills down to these precise mechanics. Liquidity equals resting stop losses. Targeting internal ranges triggers a sweep and reversal. Targeting external ranges triggers a run and continuation. Mapping the exact spatial difference between internal and external liquidity reveals institutional traps before they close, keeping you strictly on the correct side of the chart.